In this video we will be concerned with looking at the cash flow forecast. It's possible for a profitable business to be short of money. It may be the case that a successful business may be unable to pay its bills because of the timing of receipts and payments, and these pose a problem. It could be that the business is perhaps very profitable, but it just so happens that its bills arrive in one period and its receipts arrive later, so that its bills can't be paid. Now, good business management, of course, must ensure that they've got sufficient resources to meet bills when they arise. It's important for the reputation of the business. It's important to not alienate suppliers, employees, or those affected by the bills. So it's very important that the business can meet its obligations. But it seems like a paradox that a profitable business may be short of money in this particular way. But it's quite possible that the business is profitable, but the timing of the receipts and the payments, the obligations, are such that the business find it difficult to pay on time. Now I want to see how this happens, but over a period of time, management should set aside resources to ensure that there are sufficient resources put aside to meet these bills on time. So there should be reserves held within the business to ensure that the bills can be paid. There are several reasons why cash flow problems may arise. I've just given you the summary account. Well, first of all, usually production takes place prior to sales. This means that costs are incurred before the goods are sold and receipts banked. Well, clearly production must take place before sales. The product must be produced before the customer can buy it. That's generally the case. So companies therefore have to incur their costs before they make the sales. And that is one reason why there can be a cash flow problem. In many sectors, there are seasonal factors affecting the demand. This may mean that significant stocks have to be built up in advance of sales, and this puts pressure on the cash flow position within the business. Now, an obvious example of this would be Christmas cards and decorations, since they're demanded only at that time of the year. So a company that makes, let's say, Christmas cards will have to make the Christmas cards in advance of that season, but will not receive rewards or payments or sales revenue from the Christmas cards until they're actually sold. So in that case, the business must be able to afford to produce in advance and pay its bills. It must have sufficient reserves, in other words, to produce the cards, produce the decorations, or whatever it's making for the festive season, produce these in advance, and make sure it's got sufficient resources to pay wages and electricity bills and utility bills, and make sure that it's able to meet its obligations and continue to trade. So the business must have sufficient resources to enable it to do that. In general, there is a lag between the sale of goods and the receipt of cash. Credit sales have become more popular over the years, and this again puts pressure on the cash flow position within businesses. If customers expect a period of grace before they pay, that puts pressure on the cash flow position of the business. They've produced the items, they've sold the items, but they have to wait for the payment. Um, so credit sales, if they're selling the item on credit, they have to wait perhaps a long period before they get the money. Well, in the meantime, they've got to pay the bills. They've got to pay wages and salaries and utility bills, and they've got to look after the premises and pay all sorts of outgoings. And that puts pressure on the business. The business must have sufficient resources to enable it to do that. Also, a cash flow statement is essential when negotiating an overdraft with a bank, because sometimes the companies have to go to the banks to raise overdraft finance to try and bridge the gap. An overdraft is a short-term loan from the bank, but usually at a very high rate of interest. But also, before the bank grants an overdraft to a business, it might want to see its cash flow statement to see what has gone wrong. Why is there an issue? Now, let's look at some example cash flow statement or cash flow statement and look at how it works, how it's composed. Let's just skip through it. It's the subject matter of other videos on the course, but let's deal with it here as well. So let's say we have a cash flow statement like this one. So we have a cash budget, and we have it for January, February, March, up to June, let's say. And we have receipts on the top and payments underneath. So the receipts, cash receipts, debtor receipts, and total receipts. Then payments, stock, labour, rent, loan payments, services. And we may have a long list of payments. We might itemize a long list. It depends. And we would have the statement set out like this. So we'd start with, let's say, the total receipts. Well, the total receipts here, let's say for January, is 1,000. Well, that's made up from the cash sales of 200 and the debtor sales of 800. 200 and 800. The total receipts is 1,000. And for February, it's 700. 100 plus 600, just above it. So February, 700. January, 1,000. Now the total payments is the sum of the figures above the 740. So it's stock 50, labour 600, that's 650, rent 40, so that'd be a total of 690. Loan repayment is 30, so 690 plus 30, which is 720. Services, which in this case, well, let's say is electricity, is 20, so 720 plus 20 is 740. So for January we can see that the payment is 740. Now the cash receipt in January is 1,000 and the outgoings is 700. That means the net cash flow, which is A minus B, A is the total receipts, B is the total payments. So in that case it's 1,000 take away 740, which is 260 for January. For February, the outgoings and the receipts are the same at 700. So the net cash flow is 0. And for March, the receipts are 630 and the payments is 740. Well, that means a loss of 110, a loss or a deficit or a negative figure. In other words, the cash flow situation is bad in March. It's also bad in April. It's down to 60, but it's still bad. In May, it's 190, but in June, the net flow is back to 70. Now let's look at how the cash flow statement works following on from these figures. First of all, let's deal with the 260 in January. So we have 1,000 minus 740 is equal to 260. So there's the 1,000, there's the 740, and there's the 260. So now we see how the net cash flow is worked out. Now the closing bank balance in January is 410. That means the opening bank balance in February is 410. So the 410 is the net cash flow, which is 260, plus, this is for January, is 260, plus the opening bank balance, which is 150. Add 150 to 260 and we get 410. So the closing bank balance is 410. 260 plus 150. However, the closing bank balance, as I said, in January is the opening bank balance in February. So that 410 goes up, like we've shown there. That's the opening bank balance in February. And there was no change to the cash flow in February. As I said, it's equal to 0. Outgoings was 700 and the receipts were 700, so no change. So we have 410 closing bank balance, which is carried up to the opening bank balance in March. Now we can see in March that the receipts were not as much as the outgoings. They were short by 110. So we have to take away, we have to pay for that 110, so we pay for it out of the 410 we carried forward, which is our opening bank balance, which means our closing bank balance in March is just 300. 410 minus 110, giving us 300. And there's the 300, which we carry up as the opening balance in April. So that's how the account is worked out. And you can see from this it's good for the management as a statement, because the management is able to see exactly which months have a problem and can try to do something about that problem in those months. It knows when its bills are due, the size of the bills, it knows what its receipts need to be, and so it can follow up on sales and try to get payment early if possible, if need be, so as to improve the cash flow situation. Now the previous slide, this slide here, the previous slide showed a typical cash flow forecast layout. It's shown for months. However, it could be drawn for weeks. It doesn't have to be in months. We've set it out here as January, February, March, but it could be week 1, week 2, week 3. It could be particular dates or whatever. It doesn't have to be in a monthly format. The receipts figure will be estimated, and this will be based on a number of assumptions. It's important that these assumptions are made explicit and explained. So the receipts here, if we're looking forward, if we're currently in January, then the receipts for February have to be estimated. So the total receipts in February at 700. Well, why? If we're in January, how do we know what's going to happen in February? If we're in January, how do we know what's going to happen in June or May? So these figures are estimates. And estimates are based on assumptions, and it's important that the assumptions are made explicit. And also the basis for the assumptions are explained. If a bank manager looks at the cash flow situation, if the company is looking for an overdraft, as I said earlier, the bank manager would want to know what are the assumptions. Why is it estimated that there's going to be receipts of 700 in February? Why? What's that based on? Why is there an assumption that in June the receipts are going to be 900? What's that based on? What are the assumptions, and why are the assumptions the way they are? So it's important that management are able to estimate what their receipts are likely to be, but of course they're making assumptions when they do that, and they should be able to justify or at least explain the assumptions. So that's all there is to cash flow forecast. It's quite a straightforward account or document. It is very useful. It's useful for management in controlling the business. It's particularly important in small businesses to make sure that they're able to pay their debts and pay their obligations when they arise. It's important that they should have sufficient resources to be able to meet their requirements. Ideally, they should not have to go to the bank on a regular basis to raise overdraft facility. They should have sufficient resources in reserves to meet fluctuations that may mean the bank is punished or reduced in 1 month and replenished and put back on a sound footing in the next month. So they should have some reserves that tries to smooth out that. But that's all we're going to deal with in this session, so let's leave it at that and say thank you for watching.